This video, it's going to be interesting. So this video was sent to me by one of the fellow group members in one of the chat group that I was in. He essentially laid out a very interesting perspective and framework to think about your investment in Alibaba today. So let's get right into it before I provide any further comments.
Get to some of these issues during the Xi Jinping era. I think let me sort of start with the Alibaba question. First of all, I'm sorry that you're a shareholder of. But the way that
I think I feel equally sorry for many of the Baba backholders, but let's get into his main topic.
I think about that company is that there are two things that we need to think that would impact your returns from investments in that company. One is the baseline, and the other is the deviations from that baseline, right? So the policy crackdowns, the political shocks, and geopolitical tensions essentially are posing forces that will lead to deviations from the baseline, right? But the bigger question, I believe, is, and that's a little bit hard to predict, right? Because a lot of it is policy, political driven. But the bigger question, I believe, is the baseline. What is the baseline value of Alibaba today as compared with the company many years ago? I would argue that the baseline fundamentals of that company have been weakened substantially, right? So if you think about what that company did and why that company prospered, it served very valuable functions of linking suppliers with foreign buyers in the early days of that company. And then the end group was incredible in terms of developing the fintech technologies that enabled the company to match demand with, for credit with the supply of the credit to those companies and individuals that don't have the necessary asset base to qualify them for formal financial service. And those functions are now much less as compared with them before, right? So essentially the baseline is deteriorating, plus you have these deviations that may be a result of policy shocks and political shocks. So then, I think that would be my way to think about my long-term position in that company, and so, but maybe different people have different methodologies. But
I think just to jump in and to opine a little, so I think his way of thinking framework will work for most investments, because it doesn't really just necessarily apply to Alibaba alone. For those of you who have many other investments, when we run valuation models or when we look at the projection into the future, clearly it's uncertain and we don't really know whether the company is able to continuously deliver value, to grow earnings, grow cash flow, etc. Most investors usually do is to have these different scenarios that plays out. So you have your base case, your bull case, and your bear case. So in his explanation, he's essentially describing that Alibaba's base case have been substantially weakened over the last few years, while the bear case is heightened by a large extent because of these so-called deviations. So just to give you some understanding, I do believe that the market is not dumb by and large. So Alibaba's most recent sell down over the last 2 years is not completely unfounded, to be very honest. At its peak, they were trading at, I think, $310 per share. So that's at least a 3x from here. So they were commanding essentially a premium valuation of around $700-800 billion. But today, they are worth a measly $221 billion. And of course, this is without unfounded assumptions. If you were to just take a quick look in terms of their financials, and this is denominated based on the year-on-year growth rates, you can see revenue growth, even if you're to discard anything that happens post-2020, because the tech crackdown came into play. So if you look towards 2014 all the way to 2020, they were growing at incredible clips. 50%, 45%, 32%, and then you thought this was just going to slow down, and then Alibaba came in with even a banger year with a 56%, 58%. And I think post 2020, that's where you see this significant slowdown. Whether is it macroeconomics, whether is it the technological crackdown, or whether is it just a sheer disregard because of the political interference of the commerce activities, you can see that there is a substantial hit to the bottom line. Similarly, if you were to look at it in terms of gross profit margins, so 2014, you start off at a 74.5%, and they just weaken from there on. And I think in the trailing 12-month basis, it's at 37.45%. Right before COVID, or before the crackdown at least, it's at 45%. So there were many things that transpired during the last 3 years post 2020. We don't necessarily know what is the true cause of it, whether is it the COVID, the lockdown, the political interference, or a fundamental deterioration in terms of the economic mode of the company. So when we look at how the stock has reacted, at least from a price action basis, we can kind of know that, hey, the market is not stupid. They are basically pulling down the premium valuation. Alibaba probably will not be valued as highly compared to many of its US big tech counterparts. But that said, there was still a period of high growth, people getting extremely excited about Alibaba's trajectory and future, which is why they essentially bidded up the stock over the last, say, 6 years or so, from 2014 to 2020, by a factor of around 200-300%. So that's the logic. And I forgot to mention, if you guys are interested in terms of a community of like-minded investors, you want to have a quick idea on a particular company, and even to draw out the financials, earnings estimates of different companies, Seeking Alpha, not a sponsor of this video, but they did update me that they have a new offer recently. So the Seeking Alpha Premium Annual Plan, we have a special $50 coupon available, making it $189 for the first year instead of the regular $239 price. So you guys are also able to try the premium membership for free for the first 7 days. So link will be in the description box down below if you guys are interested in having such a service. But anyway, back to the baseline assumption of Alibaba, you can see that over the course of the listing of the company, there is definitely a transition in terms of the investor base. Initially, it definitely attracted all the growth investors. When you see top line growth at 50%, 40%, and it's sustainable for at least a good 3 to 5 years, many of the growth investors will get excited. But that said, I think Alibaba today is significantly different from 6-8 years ago. And I think just one of the very recent tweet from AJ Button, here's what he says. So Baba has a fair value of 157 if it grows at 0% forever. Here's how I worked that out. So Alibaba is the equivalent of 2.3 billion ADRs. So it has $27 billion trailing 12 months in free cash flow by its own ways of calculating free cash flow, though it's lower than that by many others estimate, so more on that later. So that gives us around $11.73 in free cash flow per share. So assuming 0% perpetual growth, you get a low-end estimate of 117 using the 10-year treasury and a very large 6% risk premium. So you get a high estimates of $293 by just discounting at the treasury yield alone, about 4%. So using Seeking Alpha's much more stringent free cash flow calculation, you end up with around $6.26 in free cash flow per share. So that's around half of how Alibaba themselves calculate it. So that's worth $156 discounted at the treasury yield and $62.6 with a 6% risk premium. So we've got a range of estimates going from $62 to $293. And the average of all four is $157, and that's my price target. So the average using just the lower estimates of free cash flow is 109. So there's upside even if Baba's management is lying to us about cash flows. So you can see when many of the new investors that come into Alibaba recently, they really come in with this kind of mindset, being extremely skeptical, not believing the management team, ascribing a very dirt cheap valuation multiple, and on top of that using a very high risk premium. And by risk premium, at the low end estimate, when you use the $27 billion trailing 12 month, that's a 10% discounting, which is 4% based on the treasury yield plus a 6% risk premium. So if I can speculate, this is essentially how most newer Alibaba investors came into the picture, how they look at the risk reward. And of course, we definitely have other investors on the sidelines that say that, hey, it's really not that simple. If Baba doesn't grow anymore, the EV/EBITDA multiple will compress dramatically. So markets isn't there yet. Still expecting high single-digit growth for Alibaba. Besides, I'm focused more on catalysts which actually drive the stock rather than perpetual cheap valuations argument. And if you were to go back to Seeking Alpha and if you look at the earnings estimates and how analysts are projecting them out, at least on the consensus EPS estimates for the next 3 years, you are ranging between 10 to 15%, give and take. And if you do look at revenue estimates, it's ranging between the 7 to 10% mark. So really, Alibaba is not that air quotes dead company. Competition is coming, they're coming fiercely, but really being in a large market, being able to take advantage on some of these tailwinds like commerce activities and even cloud computing, I really don't think Alibaba is going to stay flat. But I do agree that yes, markets are probably not done and multiples are probably going to compress exponentially if Alibaba is not going to grow. But I don't think we are there, and we are not going to be anytime there. Unless there are really heavy hitting macroeconomic conditions that is going to render the entire business mood because they are unable to grow anymore and consumer sentiments are at a rock bottom. So this is basically my own framework of how I look at the risk reward of Alibaba today. If you really do have a long-term horizon, let's say you are going to hold them for at least a good 5 to 10 years, buying in at today's valuation, I honestly don't think that you will lose a lot of money unless barring any existential crisis where they're going to render the VIE irrelevant and say that they're going to confiscate all your monies. But other than those kind of tail end risks, Alibaba is probably not going to lose you much money in the future. And on top of that, there are so much pessimistic arguments and pointers around it today that you're really getting in at a dirt cheap valuation. And the upside, when they do recover, if they start posing incredible growth rates, they start normalizing in terms of margins again, and you do believe that currently the baseline margins and many of these calculations are inaccurate in terms of representing the real business, then you are going to see quite a leveled amount of upside and a baseline assumption and expectation just by having Alibaba performing normally, and they don't have to be that next spectacular great run like Tesla having a 50% year-on-year growth rate again. And back to this idea of Alibaba growing at a perpetual growth rate of 0%, there is a very huge caveat here that I wish to draw out, which is an assumption on an assumption. If you do want to assume that Alibaba is gonna continue trading at a very low and very cheap valuation, you need to have a trustworthy and honest management. By trustworthy and honest management, meaning that even though they know the markets don't like the stock price today, they heavily want to discount many of these Chinese risks. But if they are good stewards of the capital, if Alibaba is going to generate consistent cash flow and income, the most intuitive and logical way is to return those cash to shareholders. Whether is it via a buyback program, whether is it via a dividends program, I don't know. But if they do have shareholders' interest in mind, that's what the least that you can expect. If not, if the money is just going to be stuck on the balance sheet forever and you are not going to have any way to realize this value, then I do agree to Felix in this case where there is going to be a perpetual undervaluation, and this perpetual cheap valuation argument is going to wake many investors up in the following years to come. On the subject of deviation, I think it's fairly interesting where many people have been lamenting that, hey, they cannot guess what the government's next moves are. And of course, the crackdown in terms of the education tech industry and also the internet companies have caused many traumas to many of the international investors. But I think I just wanted to kind of ground you in terms of some context where the 14th five-year plan, which is released back in 2021, this is essentially the government's framework and blueprint for the economy. And I just quickly scroll down because there was this term that was inkling at the back of my mind where I remember vaguely they did talk about this particular internet sectors. And there were also many other sectors that were of focus and concern for the Chinese government, including semiconductor, green energy, and many others. But when we look at it, so here, the main objective of the 14th five-year plan, so growth and innovation. So deviating from the past practice, the plan does not include a GDP growth target for the 5-year period. Which is why it's kind of like a eureka moment where you think about it, there really is lesser emphasis of the Chinese government delivering these hard numbers in terms of GDP growth targets for the last few quarters at least. Manufacturing and digitalization gain prominence. Cloud computing, big data, internet, including IoT and industrial internet, blockchain, artificial intelligence, and virtual and augmented reality will be supported. This came out right from the horse's mouth. I didn't say it. It's from their 14th five-year plan. And you really come to think of it, what companies are engaged in many of these sectors? Sounds familiar, right? Alibaba, Tencent, many of your big tech companies, are they not? But yeah, naysayers will immediately bounce back and say that, oh, look at end 2020, your end IPO, the government essentially rug pull the entire biggest IPO of history, and they crack down on gaming, they crack down on many of these internet companies. And how is this even congruent with what you are saying? I think that there is a particular nuance here, if I may share my own perspective and my opinion here. This is the long-term trajectory of where the government is going to place their focus in. That's why it's called a 5-year plan. And this is the undercurrent of where the Chinese government is looking at how to develop many of these specific sectors. That said, there are also bad actors in between, where you have anti-competition clauses between Tencent and Alibaba. You have many of these shadow banking, where Ant Group essentially start leveraging the entire financial sector. And that's when interventions have to come into play, where the government have to set new regulations about algorithms and stuff like that. But that being said, the undercurrents and the real focus of the government is right at your face. And who do you think, or which companies do you think is going to benefit greatly from this? So that's why I remain relatively bullish compared to many of my counterparts. And I do think that many of these tech companies are, I won't say at the start of the S-curve, but there is still a lot of room for growth in the future, even though many of their growth rates, margins are going to take a hit over the last few quarters. I do think that many of these are not structural in nature. So that's just my own opinion. Time will tell. With that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye.